Well, it's been a long time. 1 month. Well, to be honest, actually, I was not active on this October month because I was working on my new investments. I was finding some new companies, new businesses that comes in my purview to invest in. Like, for example, IDC. I'm sure you must have heard about IDC, but not by the famous trademark that you get in every product that you buy, but by brand loyalty and a diversified business. And to be saying with complete conviction, like, I used to think that IDC only designs FMCG products, but when I studied that business very well, I got into narrow that business, like everything in and out. I got to discover that that business is so diversified. Like, they have cigarette business, they have FMCG, they have an agriculture business, they have like a hotel chains that you must be aware about, IDC hotels. That even one business goes belly up, all the other three businesses are there to cover up their liability losses. And this is the topic for today. What instrument that banks have to cover up their liability losses? Stay tuned. Now, going further, I'm going to take you one step back to just refresh your mind about the principle of banking. And that is, take money from deposits and lend it to consumers and institutions at high interest rates so that the net interest margin becomes larger, thereby increasing the net profit. So, in this video, we'll be covering up one topic that is usually required by the banks to cover up their liability losses, and that is provisions. Now, what is a provision? Well, it's very much similar to our Indian saving system. Like every Indian household is always dependent on savings. Now, if we go back to the banking system, this thing is like a saving. It's a side capital usually required and used to cover up future liability losses. Now, to understand provisions, we have to first understand divergence. And to understand divergence, we have to understand NPAs. Look, I know that banking system is very complicated, but I'm there. I'll simplify it. Okay, so going from the bottom, what is NPA? NPA is a particular type of loan that is irrecoverable by the bank from that borrower. Well, in simple words, let's say a bank has issued a loan to a borrower and that borrower is not paying back the bank, the monthly installments plus the principal amount. That borrower is defaulting on his payments. That loan becomes NPA, and that is non-performing asset. So now I know you must be thinking that NPAs will be inversely proportional to the profitability of a bank. And you're absolutely right. Because larger the NPAs, less profitable the bank is to cover up the losses. So when a bank is calculating their NPAs, usually an average NPA ratio in percentage is not more than 10%. It's always less than 7-6%. And I'm talking about in percentage, not in actual value. Let's say if a commercial bank is calculating their NPAs and it's coming around about, let's say Bank 1, Bank A is calculating the NPAs at 100 crores. Alright? Now 100 crores is not a big number, but for a commercial bank which is starting off, it's a very big number. And RBI is the central bank of the country. It usually monitors all commercial banks financial service companies, non-banking finance companies, all the banking sector, RBI is usually the backbone of the country in financial sector. Now, when RBI calculates the NPAs of a commercial bank, RBI also does an internal audit where they calculate NPAs of a commercial bank in value. Let's say they calculate commercial banks NPAs, Bank A NPAs roundabout in 200 crores. Now, Bank A is calculating their NPAs at 100 crores, and RBI, which is the central bank of the country, that calculates NPAs of Bank A at 200 crores. Now, you see the difference between them? That is called divergence. That is divergence. So, this is a very simple concept, but don't worry, it will get much simpler. Now, when divergence is coming around about in 100 crores, now, to cover up that loss, banks use provisions. That is the safe capital required to cover up future liability losses. Now I know you must be thinking that does RBI, the central bank, has set up a guideline to convey all commercial banks to just have a 10% or 20% requirement for provisions to offset their risk? Just like when I did the video on fractional reserve banking system, I conveyed that the RBI has issued a guideline to just protect the banks with reserve requirement. A 10% reserve requirement is minimum for a commercial bank because in case any deposit holder tries to withdraw all of his fund, they should not be in lack of funds. So just to make it clear, RBI has not issued any guideline about the provision percentage. They have conveyed surely that have enough money, have enough capital to just offset their liability losses, and that's it. So I hope you understood how provisions are very much important for a commercial bank and NPAs are very bad for a commercial bank going further as operations go on. So I'm going to take a break, but by the next video I'm going to be coming up with a new topic that's going to always refresh your mind about finance. Till then, stay safe. God bless.